Welcome. In this video, I'm going to show you an ICT Smart Money approach built around three ideas: liquidity sweeps, fair value gaps, and order blocks. Instead of chasing indicators, we focus on where liquidity is taken and why price moves fast through imbalances. I tested this model on real Bitcoin data from 2019 to 2024. The results are solid: 49 setups, a 57% win rate, and about plus 112% total return on a $10,000 starting balance with controlled drawdown. Before we run anything, I'll build the logic step by step in Python. First, we calculate volatility with ATR so we can measure candle strength objectively. Then we mark bullish order blocks, strong displacement candles that often become institutional buy zones. Next, we detect fair value gaps. Now we execute the backtest. We load daily Bitcoin data from 2019 through 2024, 1,826 sessions of real price action. The engine scans for order blocks, finds fair value gaps above displacement candles, and confirms setups only when a liquidity sweep occurs near the imbalance. Every trade uses tight risk rules, a defined stop, and a short holding window because ICT entries are meant to resolve quickly. Let's break down what the strategy is actually doing on the chart. The core idea is simple. Price often hunts liquidity first and only then delivers the real move. So we start by identifying a recent low that can be rated. When price dips below that level, many traders panic sell or get stopped out. That's the liquidity sweep. The next question is, did price leave an imbalance that signals displacement? That's where the fair value gap comes in. If we see a clean FVG and price starts to reprice back into that zone, we have a measurable area for entry logic. Order blocks add another layer. They help us avoid taking random sweeps in the middle of nowhere. When a sweep happens and price reacts around a strong order block candle, it increases the probability that the move is institutional rather than noise. From there, risk management does the heavy lifting: small, predefined losses and a short time window. We're not trying to predict months of trend. We're extracting the immediate move that often follows a liquidity grab. That's why the win rate alone isn't the whole story. What matters is expectancy, average wins versus average losses, plus drawdown control. The objective is a repeatable process: identify liquidity, confirm displacement, execute with discipline, and let statistics, not emotions, do the work. Now for the headline numbers. Over the full test period, the strategy produced a meaningful sample of setups, which makes the result more trustworthy. The win rate shows consistency, but expectancy matters more. Average wins should outweigh average losses, and our profit factor reflects that balance. If you want more strategies tested with real data, no hype, no fake numbers, subscribe and turn on notifications. In the next videos, we'll go deeper into specific ICT tools like breaker blocks, mitigation, and how to align higher time frame order flow with precise entries. Drop a comment with the concept you want next, and I'll build a full backtest around it.